Hi, I'm Jeffrey Roach, Chief Economist for LPL Financial, with three key charts to explain the current macro landscape. First, protecting USMCA is the key for the outlook. Now, investors have not liked the new trade policy revealed on April 2nd. The actual calculation of country-specific tariffs is definitely suspect, but I want to focus on the key players within U.S. imports. Roughly 28% of all goods imported into this country comes from Mexico and Canada. For investors thinking about the impacts from new trade policy, one very important factor for the economic outlook is how well the U.S., Mexico, and Canadian trade agreement can stay immune to the brunt of the new tariff regime. Second, China relies on critical U.S. products. So who's going to blink first? As of this recording, the U.S. and China are on the cusp of a trade war, and if we are to analyze who's going to concede first, we have to identify who has the most risk to their country. The U.S. is the top provider for important items that China needs, and it's possible that China needs the U.S. more than the U.S. needs China. This is indeed a dangerous game, since both countries will feel the stress, but we think China may feel the greater pressure. Third, higher yields from stagflation, royal plans. One of Treasury Secretary Scott Bessent's goals is to help relieve some pressure in the fixed income markets and get yields lower. Not necessarily by Fed rate cuts, but by better fiscal policies like deregulation, deficit reduction, and energy cost management. Now, in the near term, bond markets are focusing primarily on the inflationary risks from tariffs. Yields will stay elevated as long as markets think businesses will be successful in passing along higher costs to consumers. Well, that's all for now. If you want more insights on global market trends, follow us on social media and take care.